The semiconductor sector just entered a bear market. The VanEck Semiconductor ETF has fallen more than 8% in a single week, its steepest weekly loss in over a year, and it's now down close to 18% just in July. Names like Applied Materials, Lam Research, Intel, KLA, and ARM all dropped around 4% in a single session, while Micron and Nvidia each fell more than 2%. The trigger everyone's pointing to is a new Chinese AI model called Kimi K3 from a startup called Moonshot AI, which claims to rival the best systems out of the US. But is China's AI catching up actually the reason chip stocks are crashing? One venture investor thinks the whole "China is the problem" narrative is being blown way out of proportion. Here's his take.
Our next guest says, don't blame China AI fears for the rotation out of the chips. Joining us this morning, Bessemer Venture Partners partner Byron Dieter joins us. B, it's great to have you back. You do think this notion that corporates swarm into these cheap Chinese models is overdone?
I think that's very much the case. I do buy the rotation argument that people are doing a little profit seeking after the epic run-up that the hardware stocks have had here. But this notion that Chinese models are suddenly going to crater demand and change these cost curves, I think it is totally misplaced. A model like Kimi's is a fine model. It's memory intensive and slow, but it is performant. However, what people miss is that the open source story isn't going to be different this time than it was in cloud, which is they'll take some demand pressure off, they'll put some pricing pressure on various parts of the market, but whether it's Kimi or DeepSeek or one of these other dozen open weights models, they're going to find their place in the ecosystem. But corporate America is not going to chase fractions of pennies per token and embrace Chinese technology for their most critical data assets, market needs and product needs. I just don't see that story playing out, and I think the frontier models are going to continue to lead as they have for the last many years.
So because the models, A, are not as good, or B, they don't trust them, or C, they're not allowed to?
A combination of one and two first, which is to say that these models have solid performance, certainly when you put in a price curve, but when you overlay this to the overall price performance, especially with the memory input here, and then you include the fact that it's almost certain these will be proven to have been trained on distillation attacks on the U.S. models, as time and time again they are. It's going to go to number two, which is corporate America is predicated on trust, data security, and collaboration with their vendors. The same reason that you have these tight relationships with the leading software and hardware companies today, that's going to continue. You are not going to see Fortune 1000 that are moving their data assets, their business intelligence, their employee records onto these systems. Think of the blow-up we had over TikTok and the sensitivity of dance videos and consumer data. You roll that forward to corporate assets, and it's just not going to play. And so I do expect number three is going to happen as well. There will be some level of regulation to manage this so that the dumping on pricing that China's trying to do and the distillation attacks and the IP theft and the model competition won't be pervasive throughout our economy as we're trying to drive our own AI industry and make sure we continue to have the lead here.
But even if the American corporates don't necessarily all shift over to Chinese models, Byron, it ultimately does put pressure on the prices of these tokens. There's already, I think, a lot of pushback that you're starting to hear from corporate America on just how expensive these tokens are from the Anthropics and OpenAIs.
I see it as taking some pressure out of the system because the frontier models themselves have said they can't keep up right now with demand. And so you're going to have low-edge use cases. You're going to have early startups. You're going to have experimentation and test budgets that are finding their way there. And then you're going to find that the leading companies, as they get more supply online and back to the data center story, they're going to be able to walk the prices down on their models pretty quickly. You will also see that you've got sovereign models emerging and other open weights models emerging in our allied nations, the European West and India and Canada, that will also be competitive. They absolutely will have a part of the ecosystem, a role in the market. It's just wildly overblown in terms of what people think the impact downstream will be on the leading models and on the hardware stocks. Those cases are preposterous.
First, let's get the scale of this sell-off right. The semiconductor ETF has posted its third weekly decline in 4 weeks, and the Philadelphia Semiconductor Index just recorded its steepest weekly loss in more than a year, down nearly 18% for the month. Zoom out further, and semiconductor stocks have shed something in the range of $1.3 to $3 trillion in market value since their late June peak, depending on which starting point you use. And this comes right after the sector's best quarter ever. SMH gained more than 70% between April and June. So part of what we're watching is a genuinely historic run cooling off hard, not a sector collapsing from nothing. Second, the immediate trigger. Moonshot AI, a Beijing-based startup backed by Alibaba, released a model called Kimi K3 2.8 trillion parameters, which the company says makes it the largest open-source AI model ever built. Moonshot itself admits K3 still trails the top proprietary systems from Anthropic and OpenAI on overall performance. But on specific benchmarks, coding, agent tasks, browsing, it's genuinely competitive, ranking first in several real-world task categories and beating mid-tier models from both US labs. And critically, it's priced aggressively, around $3 per million input tokens and $15 per million output tokens for the flagship version, with cheaper specialized versions running well under $1 per million tokens. That pricing is the part markets are actually reacting to, more than the raw benchmark scores. Third, and this is the part that matters for chip stocks specifically, the fear isn't that Chinese models are better. It's that a credible, cheap, open-weight alternative changes the economics of the entire AI build-out. If companies can get 80 or 90% of frontier performance for a fraction of the cost, some of the projected demand for the next generation of premium AI chips gets pulled forward into cheaper compute instead. That's the same logic that hit chip stocks hard when DeepSeek first emerged. History rhyming here is a real factor in why traders reacted so fast. Fourth, this isn't happening in isolation. It's stacking on top of an existing worry that predates Moonshot entirely. Just weeks earlier, Broadcom's earnings failed to deliver the upward AI guidance revision the market wanted, and that alone wiped over $1 trillion off the sector. Around the same time, reports emerged that Meta was renting out excess AI computing capacity, which raised a separate, arguably scarier question. Is AI compute supply starting to catch up with demand faster than expected? If hyperscalers already have spare capacity, that directly threatens the insatiable demand story that's been justifying sky-high chip valuations all year. TSMC's own results actually captured this tension perfectly. Revenue climbed nearly 34%, and profit jumped over 77% in its latest quarter. Genuinely excellent numbers, and the stock still dropped several percent because investors are now scrutinizing whether the returns on all this spending will match the spending itself. Fifth, the corporate pushback on token pricing is real, and it's not just coming from cost-conscious startups. There's growing chatter that businesses are spending far more on AI tokens than they'd budgeted for, and some are starting to ask whether the returns actually justify it. That's exactly the dynamic the guest in the clip acknowledged. He agrees frontier labs are essentially supply-constrained right now and can't discount aggressively, which leaves room for lower-cost, lower-edge use cases to drift toward cheaper alternatives, even if the most sensitive corporate workloads stay on US systems for trust and data security reasons. So here's the actual bull case versus bear case on the table. The bull case. Open-source Chinese models taking share at the margins doesn't necessarily collapse frontier demand. This happened before with earlier waves of open-weight models, and the leading labs adapted by cutting prices and pushing into higher-value use cases. Corporate America has structural reasons, trust, data security, regulatory risk, to stay with US vendors for anything sensitive. And there may even be a regulatory response coming that limits how aggressively subsidized, IP-disputed Chinese models can undercut pricing in Western markets. The bear case. Even if no single company switches vendors, the mere existence of a credible cheap alternative puts a ceiling on what AI infrastructure players can charge, which pressures margins across the entire chain, from token pricing down to the chips themselves. And separately, there's now real evidence, Broadcom's guidance, Meta's spare capacity, that AI capital expenditure may be decelerating on its own, with or without any help from China. This sell-off has at least two distinct stories tangled together. A China is catching up scare, and a separate, arguably more serious, is AI capex actually sustainable scare, and the market is currently pricing both at once. Untangling which one is driving more of the move matters a lot for how you trade this. If it's mostly the China story, this looks like the kind of overreaction the venture investor in the clip describes: tradable, likely to fade as frontier labs adjust pricing. If it's mostly the capex sustainability story, that's a slower moving, more structural concern that won't resolve with one earnings season. Either way, the next real test is earnings season. Watch whether hyperscaler capex guidance holds steady or gets trimmed, because that will tell you a lot more than any single model release will.